Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guests today are Tim Seymour, CIO of Seymour Asset Management and co-host of CNBC's Fast Money, and Christian Magoon, CEO of Amplify ETFs. We're talking about cannabis investing today and the Amplify Seymour Cannabis ETF, ticker symbol CNBS, which is actively managed by Tim. Christian and Tim, welcome back on the show.
Hi, Nina.
Thanks for having us, Nina. It's great to be on again, and congratulations on what you're doing in your different portfolios you're running. We appreciate your interest in CNBS and some of the other products we have.
Sounds good. So I wanted to start with your thoughts on the broader market action, post-election and Pfizer vaccine news. So it's been quite a wild week for the market. Stocks reacted positively to the possibility of a Biden presidency and split Congress. And then we got a very positive vaccine announcement from Pfizer, which sent reopening stocks soaring. But then yesterday, investors were piling back into the safety of big tech stocks and other stay-at-home stocks. And today, everything is down a bit. So tell us what you think of these developments and which areas of the market look attractive to you now.
Okay, well, I'll jump in first. My view on election outcome and combined with vaccine is that, yes, removing uncertainty sometimes is enough for markets. Clearly, a Biden White House and split Congress, or at least a GOP Senate, is viewed as probably an ideal outcome for those that were concerned about taxation and capital gains tax changes in the new year, in the new administration. Clearly, some expectation that a blue wave would have led to more stimulus and possibly more short-term gain, even if there was longer-term pain from the regulatory and taxation environment, and it's just all layered in on top of where we are with the vaccine. Look, from an equity perspective, my view is that the biggest driver to equities right now is that I think the low interest rate environment, the Federal Reserve are driving continued allocation to equities. And I don't see that changing in the short to medium term. It's very difficult to make an argument in favor of valuations across most sectors in the equity market, but it's not difficult to understand where if we are moving forward to not if, but when on the outcome of the pandemic, and at least some good news there that was always expected. But frankly, I think there have been times markets just have not been able to price that in. And I think the reality of the global industrial cycle is such that we are still at the low ebb of where we are seeing recovery, and that I think the market will price in well in advance of actually getting back to 100% or where we were pre-COVID, which wasn't a terribly robust place. So again, the most important dynamics right now are that we're through the election cycle. I realize that the Senate is still a very big issue and could possibly change some sentiment on the market. But in the short term, we are not responding to equity valuations. And I think people are tending to also simplify the dynamics of growth versus value in this rotation. This rotation doesn't exist in I think, an absolute or zero-sum game dynamic. I think you've had these moments where the market has seen rotation out of mega cap tech into broader, more cyclical, either later cycle or early cycle recovery stocks. But it's very difficult for me to see the market running too far from mega cap tech stocks that are still offering decent growth, offer enormous capacity, have very sound balance sheets, and in some cases have valuations that, at least on a relative basis, are not that difficult. But I'll stop here because I know there's so much to talk about. But it is an exciting time for the broader markets.
Right, right. We have seen those mini rotations out of mega cap
Yes.
tech into growth, but into value, but they last like 2 days, 3 days.
That's right.
So we will be talking in detail about developments related to marijuana industry, and it's been a pretty good week for your ETF CNBS, right?
It has been. It's been an exciting time to see not only the combination of the macro improve from the political dynamics that took place over the elections, but also the state ballots, which we'll talk more about. I think, cannabis hasn't needed a federal legalization story to continue to develop and to have very strong macro around it, especially on the state level. There's also been some tremendous earnings that have been coming through the sector, especially in the United States, where the opportunity set is bigger. But I think the awareness investors have that this is not just this is I'll quote one of the CEOs of I'm pulling the email that I got this morning from Ben Kovler, who's the CEO of GTI, who is arguably the largest player outside of Curaleaf in the United States, and they had earnings last night, and they were tremendous earnings, where they now had a string of positive net EBITDA. But as Ben said to me, and we talk all the time, as I've been saying, and I believe cannabis is the next great American growth story, and I think a lot of times people have gotten lost between just the cultural dynamic, the story of even the markets where you've had the Canadian players be listed in the United States and the U.S. players listed only in Canada. There's everybody's legacy ideas of cannabis and what it means. But the great reality here, and this is back to what's been going on with my ETF, there's an understanding that this is an addressable market that is growing every day on the state level, that it's a bipartisan issue, that it's a global sector story, but that it's a consumption story. It's a sophisticated consumer environment, and that the growth, and back to we talked market valuations where it's tough to justify. I can make a strong argument for picking a portfolio of cannabis companies that have growth that is far out exceeding the highest growth sectors in the market, the more traditional sectors people are following, at valuations that are a lot more exciting. So that's what's going on. That's what's been going on for CNBS. That's what's been going on for the sector. And obviously, we're very bullish about our approach, and why we think having an active portfolio makes a lot of sense. It's why I am someone who has been investing and very active in the sector and have relationships from not only the biggest CEOs, but I'm in the middle of the sector, and it's going to continue to be an important sector for investing in.
And Nina,
Sure.
I just want to jump in real quick here,
Sure.
because I want to, Tim's very modest. When you look at cannabis stock ETFs, there's 5 legal cannabis stock ETFs, meaning cannabis ETFs that own the legal universe of cannabis stocks. And only one of them this year has delivered positive performance, and that is CNBS. Tim's actively managed cannabis ETF is up 8.3% year to date. It's the only stock-based cannabis ETF that has positive returns. When you look at, for example, the largest cannabis stock-based ETF, MJ, it's down 19.8% as we speak today, going into November 12th. The other ETFs in the space are down close to 10%. One's down 32%. So he's been able to deliver through his actively managed approach in CNBS some substantial alpha, 10 to as much as 40% alpha versus the competition. Now, there is one cannabis ETF out there that's been in the market for the whole year, YOLO, but it doesn't own 100% stocks. About 30% of its portfolio is in derivative securities, a little bit more risky, that own illegal or have exposure to illegal cannabis stocks. These are cannabis stocks that are operating in violation of federal law, and how they've decided to expose their portfolio to it is not to own the stocks directly, but instead to hold derivatives that give them the return. So that's helped them out. They're actually up 19% this year. But again, there's increased risk, and there's a third of their portfolio exposed to derivative risk. So when you look at what Tim's done, I think it's quite impressive to be the only stock-based cannabis ETF with positive returns and to see alpha of 10 to 40% in this space. And that's why we partnered with Tim and Amplify to launch this product, because we believe Tim was the prominent kind of expert in this space, an insider, if you will, that could manage this for investors. And we're seeing the fruits of this in a really dynamic year of 2020. And just excited to see Tim be able to share his insights with your listeners today.
That's very impressive performance, and it's an emerging, evolving, and very volatile industry. So definitely management by an expert makes a lot of sense. Now, I wanted to talk about the impact of the outcome of some of the state-level initiatives, ballot initiatives on the cannabis industry. We know that New Jersey, Arizona, Montana, and South Dakota, they voted to make recreational marijuana legal. And that will be in addition to 11 states and DC, which already have it legal. Then Mississippi approved medicinal use of marijuana, and that will be in addition to 33 states and DC that have already legalized medical marijuana. So, could you tell us the impact of these initiatives on the industry?
Look, this was a Goldilocks outcome for the industry, and I would even include a blue wave taking over the Senate when I say which didn't happen, at least as of now, and I would still say Goldilocks scenario, and here's why. Yes, the federal dynamic around investing in cannabis, but more importantly for the companies themselves in terms of operation, at some point needs the full federal support. But what's more important right now is that the states themselves are executing and have control and autonomy and are able to regulate this industry on a state-by-state basis according to rules that they are comfortable with and that their own local legislator is comfortable with, and frankly have simplified an incredibly complex sector as it relates to the issues that the minute you bring in 5 or 6 other federal agencies, we've already seen the problems when the FDA came in to try to regulate around the CBD market, which through the Farm Bill had a huge victory in 2018 and ultimately led to a place where the CBD industry is almost gone out of business because of the regulatory environment that's been brought on by federal legalization. So right now, in the short run, the fact that you got 5 state ballots that went up for election on November 3rd, and you got a 5 for 5, they ran the tables, and South Dakota not only got a medical market but approved an adult market in the same ballot was incredibly impressive. The fact that New Jersey, which is not the biggest state on the East Coast, but one of the biggest states, had an emphatic victory at the polls in terms of an adult market on top of a medical market that already is a very solid market. But most importantly, New Jersey will be the linchpin to getting the East Coast to roll entirely. And we're really talking about New York. In fact, it was only a day after the New Jersey elections that Governor Cuomo was out there talking about the eventuality, and it looks like we're talking late first quarter, early second quarter for New York. Ned Lamont in Canada was quick to point out also Canada is going to follow through. They're all looking at the fiscal dynamics of the sector that is able to plug a lot of really big holes in fiscal finance and budgets around the country on a state-by-state basis. But maybe even the more interesting and impressive thing about the election night was that 3 very conservative states voted through a cannabis legislation. States that if the perception is that this is really more of a blue versus red story, boy, it is not. It's bipartisan. And the message really is not that Montana is going to move the needle for the country right now in terms of the addressable market. The message is that Montana, South Dakota, and Mississippi send a message really to Texas and to Georgia and to some of the biggest states that right now have been very conservative about their approach to growing cannabis. One in 3 people live in the legal environment, but more importantly, 70% of the country are in favor. There's 8 Republican senators that hail from cannabis states whose votes are very important. I actually think you're going to get a significant amount of legislation with a red Senate, especially where there is some consensus in the current Senate that the SAFE Act can move. Senator Crapo, who runs the Finance Committee, and it looks like Senator Toomey will now take over the Banking and Insurance Committee, and that this is a working group that will, I think, begin to make movement in the Senate. I think actually Mitch McConnell won't get behind major cannabis legislation, but if states acts pass the committee and end up on the floor, there's a large view that this would actually get approved even by a red Senate led by Senator McConnell, who has been very much against legalization efforts. So that's both election night, state by state, what I think could happen on the federal level, but maybe more importantly for investors, this gives the best companies time to circle the wagons and continue. I think there's a moat around a lot of businesses of these companies because you've kept the floodgates of a lot of the larger ancillary crossover CPG companies out of the industry because they're not going to come in until it's totally safe and totally legal.
Yeah, definitely very encouraging, very positive developments for the industry. And I read that starting next year, cannabis will be legal in some form for about 70% of the US population. Now, you mentioned blue wave. That didn't exactly happen because Senate control depends on what happens in a couple of races in Georgia. And we know that a Biden administration is expected to support decriminalization of recreational marijuana and also legalize medicinal marijuana at the federal level. So with the current, Senate, or the Senate, in case it is Republican control next year, do you think a federal legalization would still be years away? And could you also please explain why federal legalization is so important for the industry? Because when it is illegal at the federal level, this industry cannot access capital markets, and there are issues and with their taxes too. So tell us why federal legalization is very important and what are the chances?
Yes, right. So I think, as I alluded to, there's no question that there are issues with a red Senate. And we've already seen that significant cannabis legislation made it through the House. But that's not a big surprise if the presumption is that this is purely an issue on the blue side of the aisle. It's not, first of all. And again, I think that one of the important dynamics with the federal initiatives are that on a national level, people have voted and the public perceptions are what they are. Cannabis is not a blue or a red issue. So, I want to reinforce that I think that the current Senate, as it's made up, in even in a post-election environment, let's just say that Georgia is held by the Republicans, and you had a red Senate. I still think that there is enough momentum to understand the importance of how this industry needs to be able to bank and needs to be able to protect its workers and constituents, and ultimately that the revenues that flow through here are fair. So what does that mean? It means that I think there's an opportunity for even some type of legislation to go through the Finance Committee and the Banking and Insurance Committees to allow for safe banking and to allow the industry to have access to traditional capital markets. That would lower the cost of capital. That would change the access points for the broader investor group. Obviously, at some point, that would almost immediately then bring in the U.S. exchanges to allow U.S. companies to list on U.S. exchanges. That's been one of the great absurdities of this industry. And as I said, it's one of the things that's perpetuated this misperception out there that the industry, that this has just been, there's been a lot of bad investments made into a lot of companies that just are not representative of the investment ideas. And I think there was a lot of hype around a handful of the Canadian companies that frankly were not then and are not now today great companies to invest in. But they were able to list, they were able to get the most money, and they were able to take in investments from big institutions and or small mom and pop retail because they were listed on the U.S. exchange. That would change. That would change with at least some legislation around safe banking and States Act. And I think these are things that are still very much in play. Some of the biggest, most complex issues for cannabis are around social justice issues and criminal justice issues. And I think there's largely, fortunately, a view in this country that the criminal justice system has been unfairly targeting minorities, and especially around cannabis. That's something that I think the industry, even from the inside going out, is extremely sensitive to and has paid a lot of attention to, and that the criminal justice dynamics and working them through is going to be critical. I still think if you look at the spirits industry and how long it's taken for there to be more national policy and removing prohibition era restrictions on even sending product across state lines, I don't know how you can expect cannabis to get through this very quickly either. And I don't think you need to. I think one of the things that's been very important about the development of the industry so far is that there are states that have developed rules within their states that are protecting the companies that operate in them and are going to continue to allow an environment where those companies can actually be profitable. I think one of the biggest issues in terms of the federal dynamic that the industry must confront is that profits, especially through on the retail level, are still implicated as being coming from federally restricted industries, which means that from an IRS perspective and a taxation perspective, it's punitive, almost impossible for retailers in the cannabis space to be profitable because they're not able to use traditional cost accounting methods to determine profitability. You're not able to subtract your cost of goods sold, your expenses. So it makes profitability for at least, especially on the retail side of the industry, almost impossible. And that does need to change. So those are some big issues. But meanwhile, the industry is, depending on who you ask, is going to be a $40 billion industry by 2025, and it may likely be an $80 billion industry by the end of the decade, and will soon be the same size or bigger than some of these other industries we've been talking about. And this is not having to get overly philosophical and pie in the sky on use case and efficacy, either for cannabis as on the recreational side or cannabis on the medical side and on the pharma side. This is, we're talking about just consumption patterns that we've already seen. What's amazing in the current environment around COVID is that much like in every other sector where you've seen the haves and the have-nots coming out of COVID, accelerating trends that were already in place, cannabis is the same thing. Cannabis has gone from a place where not only illegal, but became essential as ruled in the crisis. And a lot of people thought, okay, well, you're just going to be pulling forward sales and there's going to be pantry stockpiling. And no, as we go well into the fall now and well through this stage, some of the most mature cannabis states in the country, and those would absolutely be Washington and Colorado, have seen year over year sales growth of 30%. And these are mature markets. So it just, there's a lot of different elements of what's going on within the industry. But again, I just want to highlight for investors that I don't, in the companies that I talk to, and as an investor in the industry, I don't need this to be a federally legal market overnight. Yes, as we've talked about, my ETF has to be, I think we have to work extra hard to find great exposure to the U.S. cannabis industry or global cannabis industry, and do that on a portfolio basis. So, to some extent, I'd love to see the U.S. names get listed on the exchanges to allow me to have a straight line to invest in them rather than have to invest kind of in either ancillary names or names that actually are global names that have exposure here as well. But the companies themselves don't need this to be a fully federal environment. The guys and girls that are the most successful operators in the space are comfortably executing right now.
Definitely a lot of growth potential in the industry. So which areas of the market, of the industry excite you most? Which have the best growth potential in your view?
Well, I think it's still very interesting to have exposure to companies that have some vertically integrated business model, because that's where there is the most operational leverage and where there's an opportunity to deliver higher profitability. Some of the names that have done particularly well in the portfolio are names that are directly exposed to the U.S. market and in many ways serve the U.S. market, but in different ways. So a company called GrowGen. GrowGeneration is the official name, but is a hydroponics retailer that is specifically focused on the cannabis industry, B2B and B2C. They are one of the best run companies in the industry in that they've been profitable really from their early days. They just reported numbers out this morning, which were their 3Q 2020 numbers, where their revenues grew 153% year over year. And that's through a combination of their existing footprint and additional organic growth throughout the year. So expansion, but then also some acquisitions. But that their same store sales were up 73%. E-commerce growing 112%. Again, themes that we've heard about in other places and in other sectors. So GrowGen, to me, and it's a company that was a smaller position early and that we've been adding to actively as we've seen the execution, is now a top 3, top 4 position in the portfolio, and a name where these sales numbers are ones that are, I think, representative of the kind of growth you're going to continue to see for them. They're going to continue to, I think, consolidate a highly fragmented retail environment. They're going to continue to be exposed to the tailwinds of not only just the cannabis sector, frankly, but some food safety dynamics and organic growing. But this is very much a cannabis play, and very much a play by folks that have taken a look at how some of the big box retailers outside of this industry have operated successfully. So we really like that story. IIPR is the name of a cannabis REIT and a name of a company that a lot of people thought wouldn't really be able to survive or won't be able to survive when this cost of capital comes down and when the federal restrictions change so that companies can access traditional markets, capital markets, but that that's been a criticism of this company for a couple of years, and again a position that we've been adding to, and it's also been growing because of its massive outperformance. But they are lending to not only the cash-strapped and smaller mid-sized players have trouble accessing traditional even credit markets, but some of their biggest customers are some of the biggest companies in the industry, including GTI, who I just mentioned, who had numbers out yesterday, who's one of the biggest operators, and did a sale leaseback with IIPR. So IIPR is lending into the industry, and because they are, quote unquote, not plant touching, they've been able to raise a lot of money, and they've been able to lend into the sector at very, very attractive yields. And this is no different than a REIT investment that investors would be looking at outside of this industry. Frankly, just not with yields as juicy. So, and I think even when markets open up and capital markets open up, in the same way that there's a place for REITs to be lending into almost every sector, especially retail, et cetera, and commercial markets, the same thing is going to happen in cannabis, and it's not going to change the business model for this company. But in the short to medium term, this will continue to be an outperformer. This is a company that's a $3.5 billion market cap REIT that's going to get bigger, and a name that we've been very bullish on from early days. And there's been a lot of criticism of some of the Canadian LPs. And what I want to just point out is that not all Canadian LPs are built the same way and are managed the same way. Canopy Growth was one of the early pioneers in the industry and grew and also became one of the high-profile stories as they listed on U.S. markets, and maybe most notably took a major investment, a controlling investment from Constellation Brands, who most people know is a very sophisticated consumer products Fortune 500 company in the spirits industry that has been a leader in new markets and new regions. Well, here they came in here, and Canopy Growth became almost a victim of their own success from the market's perspective. And meanwhile, a lot of their business in Canada was only going to get to be so big. In the last year to year and a half, there's been an enormous change at the company, including, first of all, a complete change in the C-suite, bringing in David Klein, who is the CFO at Constellation Brands, to run Canopy Growth, and other senior members that are Constellation management and sophisticated CPG operators who've operated for profitability. And one of the first things that they started to do was write down they have impairment charges, write down assets, right size the cultivation footprint, cut capacity, take some painful charges, while at the same time investing in brands and investing in different products that they think are going to ultimately separate themselves. And one of the things people have always said about investing in cannabis is it's about brands, just like it's about brands when you're investing in other consumer products outside the industry. Canopy's is as well positioned as anybody to be introducing brands. They made their they basically have a purchase on legality, an option through a transaction they did with Acreage, which is one of the large U.S. multi-states that gives them a very strong footprint. And again, Acreage, I think, is also kind of right-sized and refocused their asset base to make some really positive changes in the last year. They've done a transaction with a company called TerraSend, which I would argue is one of the top 5 U.S. operators right now, and they have Canopy Growth has exposure to the U.S. market through TerraSend. And has done some very smart deals where they stay on the right side of the federal legal dynamics, but they're working with one of the most sophisticated operators in the United States who have very strong businesses in Pennsylvania, New York, and retail outlets in different parts of the country. So I like Canopy here, and I actually think that we're as investors we're supposed to be investing in tomorrow's trade, not yesterday's trade. And as far as I'm concerned, $1 allocated towards Canopy Growth here, who's got $2 billion of capital on their balance sheet and can be as opportunistic as almost any company in the industry, more so. I think, I don't look backwards. I look forwards, and I think this is a very interesting trade here. I think it's just important to also, as an investor, to talk about, especially in an active fund, where you perform for your investors by not investing in companies that are broken structurally, balance sheet, didn't have good assets, weren't well positioned, weren't well run. And one of the ways in which we've differentiated, especially on performance, is I have not owned some of the worst performing stocks and some of the frankly the poster children for the difficult investing in cannabis that we've seen, because I just never thought they were good companies.
So you mentioned some of the earnings, and I saw that some of the largest companies in this space, they reported their earnings recently, including Canopy that you talked about a little bit, Aurora Cannabis, Tilray, Kronos, Ephria. So talking about those quarterly results, did anything surprise you? Did any company had extraordinarily good results, or someone had bad results which surprised you?
I'd prefer not to talk about the negative results, and I will just simply say that I haven't owned Aurora for a long time. I haven't. We've had a very, very underweight and almost just a token toehold position, less than 1% in Tilray for a long, long time. These are not companies that we felt terribly good about their future, frankly. And whereas we've been adding to Aphria on the back of what I think has been, first of all, strong attention to their balance sheet and bolstering their capital base. And they are, very well positioned, we think, both within the industry from a balance sheet perspective, but also they're arguably the best operator in Canada in terms of their efficiency on operations. And Irwin Simon, the CEO at Aphria, many people know him from Hain Celestial. He's someone that I had some experience getting to know and understanding how he thinks about consumer products. And they just recently made an acquisition in Sweetwater, which is an IPA beer company. I guess we're calling that craft beer, although craft beer is no longer craft; it's big business, and so is this company. But an understanding of what consumer products are. So we like Aphria. We think they've proven themselves as an operator. I mentioned that the story in Canopy is one that's changed. I think there's a turnkey U.S. footprint. I think there's top line momentum, and I think the balance sheet is a major positive. They have a product line which is CBD oriented, at least in the U.S., called BioSteel. So it allowed them to use Constellation Brands distribution partners in the U.S. Gatorade beverages. If you think about them as a comparison, a great comparison, but that's a $5 billion market in the U.S. I just think, BioSteel has the ability to grow, and something that I think at some point will continue to move the needle for Canopy growth. But I think the most important thing is that there's been a focus on profitability there, and the gross margins were, I thought, solid. So they had a top line beat. There was a bottom line that was, largely in line, but it's shown a real turnaround there. So I think, those are the stories that are probably the most notable coming out of earnings season for the Canadian LPs. I think we'll continue to watch where those companies are also exposed to the U.S. But right, in the case of Canopy, we think they have very strong U.S. exposure without legally crossing the line right now.
So let's talk a little bit about your ETF now, CNBS. And I'm looking at the top holdings: Canopy Growth, GW Pharmaceuticals, Aphria, Village Farms, Innovative Industrial Properties, and Grow Generation. These are among the top holdings in your ETF as of now. Could you talk a little bit about how you manage this ETF, how you select and weight the holdings, and also talk a little bit about some of these companies that you really like? I know you mentioned Innovative Industrial Properties and Grow Generation earlier too.
So first of all, right, why active? We kind of gotten into that, but I think part of the reason for being active in the cannabis space is that there's not only a lot going on in the macro, but there's a lot going on within the companies themselves, and that's M&A consolidation, corporate governance dynamics, and as we mentioned, there's a company called CanTrust that we've never owned, and we pay a lot of attention to balance sheets. When the market was hemorrhaging, one of the things that I was able to do in terms of my stock selection was also try to put as much capital into more defensive holdings during a time when cannabis stocks were getting destroyed. So part of the value added is outperforming in down markets too, and sometimes that's obviously a lot more difficult. But as a lot of investors have heard about what's going on with SPACs, so special purpose acquisition companies that have been very popular ways to raise money and list in sectors outside of cannabis. It's also been a big play in cannabis. And SPACs are listed in the U.S., especially ones that may be investing in sectors that are legally permissible. And they are names that I can own in the book, and they are names that in the portfolio were very, very defensive. So I weighted up into what I knew were going to be what we would call portfolio stabilizers during difficult markets, because these are companies that hadn't made acquisitions yet, and I knew they weren't going to make acquisitions yet, that hopefully are going to be good acquisitions, but in the short run, I knew it was a great place to park capital. I have to be invested. I also have to determine which of the non-core names. Now, remember, to be a cannabis ETF, we have to have 80% of our portfolio be in companies that get more than 50% of their revenue from cannabis. When the market's running, you'd want to be at 95%. When the market's not running, you want to be at 20%, and you want to own companies like PerkinElmer, which is a testing aid company, which has absolutely business in cannabis. So this is me still investing in the sector ancillary, but a big medical testing company that I also felt very comfortable with and really outperformed when the market was going through a difficult time. So I just want to give you a little bit more of the context. I think when the market's running, you want to turn up the heat, and you want to have more leverage in positions that are going to move the most, of course. And I've been able to do that. And in the names that have been running, I've taken concentrated positions. I've not been afraid to put concentration in the top of the balance sheet in names that I think we're going to outperform the most, specifically a couple of the names that I mentioned. So let me talk about a couple of the other names. Village Farms is a name that I added to, I've added to over the last few weeks, especially as I saw them coming to conclusion on completing a purchase for assets called Pure Sun Farms, which is essentially a one of the I think the most profitable and best run cannabis operators in Canada, and where the company had exposure and had the ability ultimately to consolidate this company into their balance sheet. And they did so very effectively. As the industry was selling off, they were able to get these assets a lot cheaper and complete a transaction at a much more cost-effective way than they would have a year and a half ago. They've just completed that transaction. Ultimately, they're going to be able to consolidate those numbers into their balance sheet, but into their income statement. And when they do, it really means that you can see where they are trading very, very cheap on an EBITDA basis. And again, a company that has EBITDA, a company that's been profitable, unlike a lot of their Canadian peers. So I saw this as a catalyst. They operate in the deep value part of the Canadian sector in flower and vape. They've had 8 straight quarters of profitability. It's a company that we think are going to be even more profitable and taking market share within Canada and have exposure to the U.S. and will have optionality into the U.S. When that market opens up to them. So again, a name that we think is going to be there for the long haul and have exposure across the sector. In the case of GW Pharma, this is a name that's been a frustrating holding. This is one of the names that I think at least had been one of the darlings in the early days of the industry when people were looking at the pharma dynamics and the ways to get exposure. And GW Pharma, through its Epidiolex drug, which treats epilepsy and has had an enormous amount of success in doing that, and especially for younger patients, it's been a story that I think on some level has been successful in spite of itself, and that we've actually not been able to see the company really rate on the true kind of biopharma multiple that normally I think you'd be seeing a company like this doing. And in fact, just to be clear, this has been one of the higher weighted names in the portfolio from inception. And for many months, it was a big underperformer. And it was a big underperformer because I think there was some question about their European growth. There was a bit of question about the some of the follow through of the drug and the patients. And there was, I think there was still a fair amount of what came through. But if you look at their third quarter numbers that came out about 10 days ago, the core sales around Epidiolex were significantly better than expected. So they came in, I think they beat estimates by about 6%, and at $133 million, I believe. And the U.S. is still most of that market, but the opportunity across Europe is good. And the update on the pipeline is that they've initiated on a bunch of spasticity studies and other, I think, ways in which the company will continue to be developing. But the more important part of it is that the balance sheet is very impressive. The cash flow dynamics for this company in the near-term future, I think, are very attractive. And this is a company that I think will continue to outperform and deserves a heavy weighting in the book. So it's going to, I think, be one of the top players in dealing with seizures, Dravet syndrome, irritable bowel syndrome, and other seizure disorders. And I think its first approved product, Sativex, is one that's going to continue to grow, and that we barely scratch the surface on that for this company in terms of revenue. They're going to close 2020 with a top line around $525 million is kind of a street estimate, and we think in 2 years that's going to double. So it's a company with their best days in front of them, even though at times this was a proxy play for the industry and may too have gotten a little ahead of itself. But we're here to invest in trades for tomorrow, not trades from yesterday. And I think clearly a stock that went from $180 down to $70 at the lows of the crisis is one that went through a painful period. But again, that $180 number at the peak of the euphoria of the cannabis investment cycle was not the right number either. And I think this stock re-rated to the downside and has a lot of opportunity ahead of it. So it's why it's near the top of the balance sheet again.
So any final thoughts about investing in this space? Anything investors need to watch out for?
I think investors just need to be careful that there are going to continue to be periods of euphoria and manic focus on the cannabis industry. Investors that want to own cannabis for thematic reasons are right. They want to be a part of, yes, this generational opportunity, but they want to be invested because of the growth dynamics, but also just the same sophisticated investment metrics that are measuring success and investments in consumer products. And some of those companies will also be coming into this industry much in the way there was some early headlines on that 2 years ago when some of these strategics were knocking at the door. That will happen. But investors need to be in remembering that there's a lot of companies out there that don't have strong balance sheets, have had to do very dilutive share issuance, and have significant hurdles to their balance sheet, frankly. And I think it's just important that they understand those dynamics when they're investing. But that investing thematically in cannabis should be extremely exciting, and that's why the ETF industry overall has been a very important place for capital to be allocated, and in some cases more than others. So we like to think we're thematic around one of the great investment stories of the last 20 years and the next 20 years, but that you need to be active, and you need to be in the middle of the sector, and that you need to meet with companies, and you need to meet with regulators, and you need to understand the other players in the industry. And I think those are the things that I would stress to investors. Make sure that that's who you're investing with. That's the most important thing.
Sure. Makes a lot of sense. That does it for this episode. Tim, thank you so much for joining us.
Nina, it's a pleasure to be here. Thanks for the opportunity to have a balanced and thoughtful and rational conversation on a sector that sometimes doesn't feel that way to people when they're looking on the outside in. But it's a great conversation we've had today. Thank you.
Thanks for listening. If you want to learn more about these ETFs, please visit the ETF section of Sachs.com. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. And also make sure to subscribe so that you do not miss any episode. If you have any comments or questions, please email podcast@sachs.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.